across to Samir Arora, founder of Helios Capital, who's joining us now to talk more about markets. Good morning, Samir.
Hello, Ji. Good to see you.
Good to see you. Good to see you too. I mean, so what a nice place you are sitting in right now. You also don the hat of FII. So everybody is waiting for FIs to resume their big buying January onwards. They have not participated in dollar crack.
No, this year they have. This year some 20
partly, but no wholeheartedly. And MF as well. Of course, you are Desi boy as well. So you actually on both the sides. But do you expect this inflow to accelerate from the FI side into India in Jan onwards?
So over the year, 100% that the number should be better. I mean, 100% is high probability. Nothing is 100%. But the thing is that generally this 20 billion or so that I think we've got this year is also a good number, because previous last 1.5 years, there was actually outflows of 30 odd billion. So when when domestics were buying, foreigners were selling, and the dream scenario is that both will buy. And that is very reasonable to expect in next year, because people always look at last 2-3 years performance and that India has done well in absolute and relative. And secondly, they are still a bit upset with China, and that allocation, some part of that could flow to India. Plus in India, if they are looking for political certainty ho gayi, and also that the US rates are being cut. So therefore, in general, they'll be more bold in investing in outside US and in emerging markets and non-dollar. So from all those points, it looks that the flow should be good next year, yes.
Okay, so case for strong flows next year. The other thing I wanted to talk to you about, little macro, a bit gyan, but I wanted to understand the importance of it, which is that dollar index is cracking big time after topping out at 105, now below 101. In fact, US
is not.
So how does it really impact flows to EMs?
No, it generally when if you're playing a non-dollar trade, that means you'll go to emerging markets, because then you are not worried so much that the currency will give you losses if you invest in non-dollar. So as soon as interest rates peaked, or the feeling came that now rates should be cut, the dollar index started weakening. But in India, we are not getting that benefit, which is a bit sad for us as foreign investors, that the Indian rupee is pegged more to the US dollar and not to the US index. And therefore, if you see this year, we could have, all the other currencies have gained, but India has not. But hopefully, also it means that it won't, because we in the end count our NAV in dollars. So as long as it doesn't depreciate against the dollar on a bad day, then it all doesn't matter. But the point is that as soon as the dollar currency, the dollar index starts weakening, basically big picture macro is that you are willing to invest or are already investing in non-US assets. And that is why that is happening. Or because you're expecting that the US rates will be lower, and therefore that also makes the dollar less attractive compared to other countries which may have higher carry. Other currencies which may have higher carry.
Sure, point taken. I would love to hear your picks and thoughts about 2024. But before that, Samir, I want to hear about what are you doing on New Year's Eve? Where are you celebrating that? What's the plan?
Actually, I always celebrate before, because Singapore is such a nice place that on New Year Eve you should be in Singapore. It is well decorated. It's beautiful. You don't have to deal with crowds. And this time to January 1st is a working day. So it will be somewhere in Singapore only, not some jazzy location out. But Singapore itself is a jazzy place to be in.
Actually, I take that as an invitation. We should also probably get to spend some New Year's sometime, because I mean, first working is something which is just very deplorable. And
yeah, really. But I heard COVID cases are picking up.
Actually, Singapore is closed, but India is open. Otherwise, Singapore is holiday.
Oh, it's a holiday in Singapore.
Oh, I think most of the places actually have a holiday except India.
Every place will have. US has a holiday. Everybody has a holiday.
If anybody from SEBI is listening to us right now, please take this request on board. First should be a holiday. It's
pointless.
Just, I know, and I think volume is also usually
in India, we work on Diwali also. Whatever you call it, trading, but it's on.
Yeah, we crib about it, but can't really do anything much about it.
But okay, now coming to the New Year picks, and before stocks, okay, let me take some of the New Year picks from your reading list as well. An avid reader, what is on the radar, Samir, this time?
So first of all, on the picks or on the books? Books I'll come to later. On the pick, my first fear is that January will not be good. Because, every time we come into a market with high optimism and total excitement, and that it's always disappointing. We want our first month to start well, and I hope it does. But I have this feeling that the results in some sectors will be truly bad, like in IT and also in many consumer areas. Now, whether the market can handle it and say, like it did, let's say after demon, that doesn't matter. We have flows coming in. We are looking 1 year ahead, 18 months ahead, even though the numbers might be bad. This time, that I am not sure that whether the same thing will play out. I am going to be a bit circumspect in Jan if we can handle the bad results well as a market. Otherwise, it'll become very sort of, market where again we say stock specific, but first at a market level, you want the market also to do well. But to me, I think some of the hype is a bit too much. And you can already see signs of that cracking up. For example, IPOs which are oversubscribed 70, 80 times, if they are opening 10 and 20% higher, the end game of this is somewhere near. And I really believe that some of the consumer companies, consumer durable, consumer discretionary, all those other than auto and IT will be really bad. Let's see.
Fair point. I want to talk to you about one sector which again we are getting very mixed feedback about is the cement space. I mean, we saw massive rally in large cap, mid cap. You have a cement play. You somewhere or the other you are rallying also on hopes you'll be bought out by a bigger player. But when we speak to analysts on the street, they are saying, boss, on ground things are not so hunky-dory. In fact, prices are down.
We also agree. Now we don't have any cement play, and cement, this thing is down. And actually, we never used to buy cement. We had bought this Abuja as more an event around the issues of the Adani group in Feb. But otherwise, in my previous 25 years, I may have not owned cement even for a day, perhaps. So we are not very much into it, and I normally don't own it, so I can't say that currently I don't own it, so it's a big statement. So don't view this one like that.
Did your Ambuja play now?
Sorry?
You have exited that Ambuja as a play, tactical play. Okay, great.
That was a trade around an event. We are not into cement and all these things.
Clearly. But
played out.
But I must say that your conviction in HDFC Bank is paying very good dividend. It's almost at 90.
It's not paying, but
Hopefully
highest confidence I have today is in financial sector. And in that, all these 2-3 stocks, I hope that now 2 years we have passed not making returns from HDFC Bank, and actually ICICI State Bank also not a lot. I think this is their time, because even relatively, I think that the other sectors are going to have more result-related issues.
What about the slew of IPOs that have been hitting the market? Any take on that, Samir? Any interesting companies?
So the thumb rule in general, always when I was not in the middle of that market, is that what brings down the market is the IPOs and the number of IPOs. You look at it in 99, 2000, you look at it in 7, 8. The number of IPOs, if they increase beyond a point, generally they bring down the market, because then in the end, some few IPOs start failing and everybody realizes it's not free money. And also they take a lot of money. But here now the story every day is, Indian retail knows everything. They don't know anything according to me. I think people think that because you have internet, so therefore, now the people are highly informed. I think they are zero informed, and maybe they are negatively informed. And just today morning in the gym, I was seeing these CNBC Asia or Singapore was rerunning the meme documentary on GameStop and all. It was 1.5 years ago. It was the same retail, whether Indian retail, US retail. So let's not get carried away by the brilliance. I think everybody's overdoing it to be oversubscribing IPOs and SME IPOs, which have 27 crore float. You put in 70,000 crore, it does not show, or 7,000 crore, it does not show that there is 7,000 crore waiting to invest in that IPO. It means everybody knows that since it's only 27 crore, it doesn't matter if I put in 500 crores, I'm not getting it. In some of these bigger issues, you get what you want and you see what happens, which happens in many of these issues which fail in the end, that suddenly you get allotted everything or a large proportion, much larger than what you thought you will get when you put in the order. You look at these QIPs of these 2 banks that happened, state-owned banks. I mean, the issue was some 4,000 crore and they're putting in 80,000 crore. You give one hedge fund what he actually ordered and see him blow up live in front of you. Cannot be like this.
Samir, yeah, we
You
are talking
cannot
about Bank of
inflate
India
away your demand
and
like
Indian
that
Bank
to a
QIP.
limit.
Yeah, you're right. We are talking about Bank of India and Indian Bank QIP,
Yeah, I mean,
not even going
the
in SME
sizes were so
direction.
obscene that if one fund was actually given saying, okay, sorry, you wanted it, here it is. The whole thing would, that guy would go under, I think.
So
Because
actually,
the
it
way
is
they
kind of
inflate
a
these orders, knowing
created.
that there is no size. So what I mean is, you can't force the market just with flows. You can't just say because I have flows, nobody can touch the market. The flows have to be directed correctly or just relax. We want returns over the year. We don't want them every morning.
Busting a very widely held myth that just because flows are good doesn't mean. And this is an artificial, demand supply mismatch being created to actually bring in a lot of participants. But it's very good that you have followed among HNI retail very widely here in India. It's good that you're bringing out in the open. So this is one telltale sign that, one should be a little cautious, not only January, in general. Any other sign
on
on
these things?
the ease of making money in the market, or any other sign which you would like to caution our
No,
viewers?
there's no other sign that way. The only thing we can do is see the difference. Say, for example, in US, if you see 5-year or 10-year performance of S&P, and then you see 5 or 10-year performance of, say, equally weighted index of the S&P, you can see that in the long term, they are broadly similar, but last 1.5 years, they are like 10-20% different. So, broadly over time, these things will revert, maybe not fully, but at least in the long term, it fully revert and slowly revert. It's the same thing here. You look at the performance of the mid cap, small cap index for 20 years, 10 years, but just end them before this rally, say end them in 19. And then you see in 21, 22, they are beating that market by 30% per annum. It's not possible. If it never happened in any other phase, once you took the bull and the bear or the whole cycle together, you know that if it goes so out of line, it will mean revert. It doesn't need some great PhD or something. It just needs normal looking at the numbers and saying this difference cannot be this big. Once in a while, for a stock, it can be, because that stock actually has done something. But at the full sector level, at the full class or category, it cannot be. Broadly, you know that. So just be a bit careful. Don't go there, go in the other direction. Every day, I swear, every day, some distributor tells us that why are you not launching a mid cap or a small cap fund in India? Because now the easiest way to raise money is by doing a mid small cap fund. And I'll be able to demonstrate 100, maybe 20 baggers or 50 baggers, 30, 40 in my life, but we are not doing it. It is wrong. It is overdoing it.
Absolutely appreciate that, and it's good to put that sage advice on board. But Samir, I just wanted to shift the focus a bit and talk about India versus China. Now, this year, of course, we know what the clear outperformer is, but then there is that attractiveness in the sense that what hasn't done well might just do well, and it's very undervalued. How would you peg India versus China right now?
No, so we don't do that much, but in our global fund, just on Friday, and again today, we bought on Friday and we are adding more today, Alibaba, trading at 8 times P and all that. The point is that, but it will be some 2-3% of our fund. I don't know so much to say that that China is better, but once in a while somebody can say these 3-4 stocks are better. But at a big picture level, people are much more frustrated. We never invested in China in any way or meaningful way, or even 1% till recently. But let's talk about these institutions, these sovereign funds, these endowments, who also have philosophical issues that you don't, because you've already over-invested over 10 years, and then you've been disappointed on policy making and this and that. So for them saying, okay, one stock is cheap, therefore I will stay, or 5 stocks are cheap, or 10 stocks are cheap, may not do it. I think India's story is that a small part of that allocation will change because of just the way investors have been treated. I mean, stock market investors have been treated in the sense that people may not mind losing money if they make a wrong decision or they go into the wrong stock, but they get more upset and frustrated if they feel that these were whimsical policies of the government or of the system or that somebody got raided because they felt that this was some state secret, or some of their companies got hit and they know something more than what we know from newspapers. But overall, it is clear that they will not get their indexed weight in the next 1 or 2 years at least, and then we see. And the beneficiary of that is India, because the other big countries are Korea and Taiwan. And Korea and Taiwan, at least Taiwan looks the same trade as China. There are other risks. And Korea also has similar kind of stocks and all that. So India looks the most logical beneficiary of any reduction in flows to China, and any reduction has a high probability that there will be a reduction. It doesn't have to be zero. It doesn't have to be negative. It just means the new flows, at least they have to have, reduce them. And that, I think, is the starting point. We are not dreaming of a situation that people will redeem from China and start buying India. That is too wild, and we may not be able to even handle that size of flows or those volumes in terms of this thing. And we don't have to go that far in our thinking or in our hopes.
At the portfolio level, Samir, if you had to don the hat of the advisor, what would you say is a good portfolio allocation right now? You talked about China. What about US? What about bonds? What about the other asset classes?
We don't do all that. We are equity guys, so we like USA number one because it's just a big market.
So what in USA? Are the tech stocks or something else?
Those techs, we have 6 of the 7 techs in our fund. We don't have Apple, but other 6 we have. And anyway, that I don't manage that fund, but basically I know everything that is being done there. But broadly, US is a good market on its life. It is just a market where innovation is there. Now, these weight reduction companies, both we have, Merck and Novo Nordisk, I think it's Merck, I forget also, whatever, those 2 weight reduction medicine companies, all this action happens there. All the starting technology, all the innovation, everything starts there. We all just copy them around the world.
You're saying US over India in terms of market?
Sorry?
You're saying US over India in terms of the return expectation?
No, maybe not now, but in general, US has been very good. But the US, I'm not talking for an Indian investor, not for me. I run an India fund. So for me, India is, when you ask me that question, I am not like a fund manager saying, hey, hello, I run an India fund, put 100% in India. If I meet a foreign investor who says, how much should I have in India, or even an NRI, I don't say put 75% in India. I say normal fellows put 5, you are an Indian, you know India, you put 20. If I tell him to put 80%, and he'll think that I'm just selling my own investments all the time. I'm just in generally sense US is a big market and it does well. But India, of course, we are India-centric. Our experience, track record, history is in India. So for us, India may be more. But I have to clarify that. If you ask me which is the best stock, I can say generally HDFC Bank, but doesn't mean I'll say put 100% in HDFC Bank. I am not sorry, like the typical fund managers who come.
Okay, so which do you believe, apart from financials, I know you've spoken a lot about it, will be the most promising sector for the year ahead? And what is one thing that you guys maybe have never looked at and will never look at as a space or a sector you want to steer clear from?
We are flexible. So, for example, all our life, you would associate me with saying that I don't like PSUs. And over the year, we have now 7 PSUs. We have HPCL, we have IRCTC, we have the old State Bank that we always had, we have Bharat Electronics, whatever. So maybe now there are 6 because we bought one of these QIPs and sold it off. So the point in general is, right now, if you say what we will not buy, we normally say we don't buy where government is a large customer in infra. Now let's see how long we stick with it.
In fact, sir, I want to understand your thought process for HPCL. Not only HPCL, but oil marketing companies historically have always been treated a point A to point B trade.
You cannot point A to point B trade.
So this is a point A to point B.
Right. But the difference is that HPCL now is becoming a little bit more self-sufficient in the sense that they used to buy oil from outside. Now they have their own. Secondly, they are spinning off their lubricant business. And thirdly was that we were all waiting for the fact that, when elections come, you can't increase prices and all that if oil prices go up. But then in the end, we thought that there are only 4 or 5 months left for elections anyway. And in this period, even if they get less flexibility, the market may look beyond that, saying that when the new term starts, maybe the government will be more aggressive, even, and maybe selling off a little bit strategically or otherwise. And it had become too cheap at some 4-5 times with some 5-6% dividend yield. So we can change our mind if somebody somebody convinces us that the mind needs to be changed.
Okay, fair point. I mean, yes, I mean, all the there was a lot of efficiencies being extracted out of PSU. Started with PSU banks, power, so why energy should be left behind, and again the value play. Where else do you think there is scope for reform in this term or this new year by this government, where you could play a PSU theme? Do you see scope for more value still left in any PSU pocket?
I don't know, because these ones, my team has to bring. In my heart, I don't go looking for.
Sure, I'm sure.
Because generally, I was so against them all my life.
But the argument was so strong that you couldn't.
What is happening?
I
am more interested in what is happening to Paytm and what is happening to Zomato. Those are my kind of historic, in terms of, or Varun Beverage or something. But I am not inflexible.
Sure. That's how a fund manager or somebody who's heading such an organization should be, isn't it? But Samir, are you looking at pure metals, commodities, aluminum, steel?
Again, we don't look at those. We are not easily, and that even in my team, nobody really looks at it. Every day we have a morning call. We don't talk about it.
So how long can this, winter for consumers last?
Outside our normal range of going into PSU, but now metals is one more level of macro thinking, which is beyond our simple brains.
Since you look at India so closely,
plus, if you think that China is doing badly, if you think China is slowing, if you think the world has spent too much money, that the fiscal deficit of the world is high, big picture is not so exciting.
Okay, I want to know your thoughts on consumers, because pure play FMCG have been having a weak quarterly numbers for several quarters now, as in to the extent that they have stopped commenting about the outlook now. When will it? But mean reversion is something which happens, right?
No, but mean reversion doesn't happen just like that. Mean reversion, There should be that they are doing well. See, why we say that HDFC Bank or ICICI Bank may do well, as a stock, is because otherwise we know they are doing well fundamentally. Therefore, the preference of the market can change. But you can't say that a stock is doing badly, but its mean reversion will happen when it has not become cheaper. Like say for IT, why do people talk about that the IT might pick up? Because the IT stocks show that there's already a pickup. The IT stocks are up 30, 40, 50%. If you see the performance of most of these mid-cap ITs from 2019 December to 2019 March to now, so that pre-COVID, and you say what is their earnings growth cumulatively, it'll be in the range of 60% to some 100, 120%. And the stocks are up 4 times, 3.5 times, 4.5 times. So you know that what reversion, this thing that the next year will be better, because at best they're all talking about 8, 7, 10% growth in 25 over 24. For that, these stocks are already up this year 20%, 30%, 40%. So I don't understand why people keep saying that IT might recover and IT might this thing for next year, which is lower than our GDP growth in nominal terms. But that you can say some reversion if a guy is doing well, but the market is ignoring it. If the fellow is doing badly, the mean reversion may not happen. Also, if you see some of the other stocks, the big names, which were really expensive, their numbers are okay, but nobody cares anymore, including the biggest finance company in India, because it became too much. So that needs time to absorb, time to consolidate, and that could be 2 years, 3 years, 1 year, whatever.
Samir, before we let you go, that question on books, and are you a guy who believes in New Year resolutions?
No, I don't believe much, but these days I am a very reformed fellow. So whatever resolutions people have, I'm already doing. I'm exercising. I'm not eating desserts. I'm going to the gym. What is the 4th resolution? I've never heard anybody make. So
less phone time, less social media. Are you addicted to your phone? Then maybe less time.
That I don't consider that as actually, according to me, Twitter.
No, but are you addicted?
Twitter saves me time. So, because for example, previously, if I had some fatta, I had to call 10 people and tell them, oh, I thought of this. Now I can just pull anybody's leg and off it goes. It just saves me time.
Good thinking there. But on that note, we'll let you go, Samir. Good to be speaking with you and have a happy 2024 in your perfect avatar.
As a reformed person.
Okay, let's take